Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Devon Energy looks like a super nice high yield dividend stock. Depending on where you're getting your dividend information, it looks like you're going to get a 9% yield. The stock has been a massive winner over the past few years, but I'm going to tell you, Devon might not be the best stock to buy depending on what you're looking to get. I'm Jason Hall. This is The Smattering. And Tyler and I are going to talk about two other stocks in the oil patch that we think might be better buys than Devon, again, depending on what it is you're looking for as an investor. Hey, Tyler, the one that you want to talk about is pretty compelling. But before we get to that, let's talk about Devon Energy and what's interesting about it and the good things that might have investors' attention right now.
So if you look at Devon Energy, it's an exploration production company, which means that they're about ownership of acreage and actual production. And from that aspect, they have shown over the past couple of years to be one of the better players out there. Based on their most recent quarterly numbers, their production numbers are up about 11% annually. But unlike what we saw in years past, where it was mostly funded by debt and not throwing off free cash flow, Devon Energy has been just throwing off an immense amount of cash that they have been returning to investors in droves. You mentioned they have a variable rate dividend, which has been incredibly high over the past several quarters, in large part because of high oil prices. But at the same time, on top of that variable dividend that they've been paying, they've also been buying back a significant amount of stock. They're about a $30 billion company, and they have an authorization to buy back $3 billion worth of stock. So we're talking about a 10% market cap reduction in share count on top of this variable rate dividend with 11% increase in production. Those three things together make for a very compelling value proposition. Keep in mind, though, for all of the things that the management can do and can control in terms of cost, in terms of operations, in terms of capital allocation, they are beholden to the price of oil. Exploration production companies are levered bets on oil prices. And as much as Devon can try to control its destiny with the things that I just mentioned, it is still going to be beholden to those things that are completely out of its control and completely out of your control as a shareholder, and it's likely going to drastically impact your returns one way or the other.
I think that's the key. It's your opinion's one thing, but you have to get it right.
Your opinion doesn't matter as long as if it's wrong.
Yeah, exactly. So Tyler, I think you're right. I think that's the most important thing for investors. If you're looking at Devon Energy, you need to understand what you're buying. And I agree. And I don't think it's a derogatory way to put it. I think it's a factual way to put it. If you look at these independent oil and gas producers over time, their stock price movement is very much with oil and gas commodity prices. And they tend to move up faster when prices go up, and they move up higher. But then when those commodity prices come down, they fall a lot quicker. That is a reality. But the way the model has changed with setting a very low base dividend and then paying a variable amount based on cash flows, you do get that dividend kicker now, which I think is nice. But you can't go into these with the idea that this is going to be a great dividend investment. If you're looking for income and you're expecting the yield that you get now and the dollar amount of dividend that you get is going to be what you're going to get in perpetuity, you're setting yourself up for economic hazard, right? So I think that's a really important thing to remember. But if that's okay, and you still like where Tyler's talking about, you like where we are in the oil cycle, and you think their ability to leverage oil prices, grow their cash flows over the long term is still good, and you're willing to ride out volatility, I think it's an interesting place to look. But I think instead of looking at Devon Energy, I think Pioneer Natural Resources, ticker PXD, is one that I would suggest that people take a look at. I think Devon may be able to grow its cash flows a little faster from growing production, maybe than Pioneer. But I think the price you're paying for Pioneer is really compelling right now. You're looking at less than 7.5 times free cash flow. And that works out to about a 13.6% free cash flow yield versus 8.5% free cash flow yield for Devon. Again, that number can change based on how their cash flows can change. But based on where we are in the cycle, based on where their businesses are, I think you have to think about valuation for these. And I think Pioneer Natural Resources is probably the better valuation bet right now. And you're going to end up with better returns, assuming the market is favorable in the near term. Tyler, take us somewhere different, because these aren't the right investments for a lot of people because they're looking for stability, and you're not going to get that stability from these E&Ps, particularly with the dividend. The refiners are an area that you like, and I know you found one that is you think is just deeply undervalued.
I want to throw a number at you because you just said a great free cash flow yield of what, 12% for
13.6.
13.6. How does 31.6 sound to you
It's
for a free
bonkers.
cash flow use?
That's
That's what you're
bonkers.
that's what you're getting right now.
What that means, I want to put that into another number that makes sense. That means that if you bought a company, you paid for the company, and that was the free cash flow yield, you would be getting back your cash that you paid for the company in about every 3 years and a quarter. And you get all of your money back in free cash flow. It is
Yeah.
remarkably cheap.
Yes. And that is Marathon Petroleum. So, as Jason alluded to, Marathon Petroleum is a independent oil and gas refiner. It is the additive manufacturing aspect of the oil and gas value chain, and additive manufacturing finds a way to create value in almost any form of the commodity market. They're able to move products so quickly in and out of their systems that they can make profits pretty much in any oil cycle. But there's a lot of other factors that have happened in the refining space that make it better. That particular part of the industry has consolidated immensely in the United States. So you have higher capacity utilization. And with factories, if they're running at very high utilization rates, they make a lot of money. Management has done an excellent job of returning that cash to shareholders. In the past 12 months alone, they have bought back $12.2 billion worth of stock, and this is a $48 billion company. The dividend itself, in terms of yield, it's not that high. It's only 2.6%, but the company is also buying back 26% of its stock. So your total yield or your shareholder yield of the dividends, the stock buybacks, and all that is immensely greater. And for something like that, if you're really looking to get invested in the oil patch, I would highly recommend people start looking in these other places because I think there is an immense amount of value in these undercovered, unloved sections of the oil and gas market.